Welcome back, everyone. Today, we're diving into a topic that's always on everyone's mind, the stock market.
Especially after the wild ride it's been these past few years.
It really has been something else. Nobody could have predicted just how strong 2023 and 2024 would turn out.
A real surprise for sure. Trump's re-election definitely added fuel to the fire.
And you can't forget the Fed taking a slightly softer stance on interest rate cuts. Those macro trends really have an impact.
They really do.
But let's get down to brass tacks. Today, we're focusing on 5 companies in particular: Shopify, ServiceNow, DoorDash, Goldman Sachs, and Royal Caribbean.
A good mix of sectors there.
Before we get into it, though, be sure to hit that subscribe button and give us a like. It helps more people discover our deep dives.
We really appreciate it.
Now, if you were starting a stock portfolio from scratch, what are the absolute essentials to keep in mind?
You always need a solid methodology. Think of it as your market roadmap.
A lot of people talk about the IBD methodology. What's the deal with that?
Well, it focuses on companies with strong earnings growth.
How strong are we talking?
At least 25%, both quarterly and annually.
Okay, that's significant.
But it goes beyond just numbers. You're looking for companies that are really shaking up their industries. True innovators.
Game changers, right?
Exactly. And here's the interesting part. This methodology doesn't shy away from newer companies, even if they're not profitable yet.
Really?
If they're showing massive revenue growth, that's a sign of potential. Think of them as rockets ready for liftoff.
So a proven track record of growth, a forward-thinking approach, and a dash of disruption. Sounds promising.
That's a good starting point.
But timing is everything, isn't it? How do you know when's the right moment to buy?
That's where understanding stock charts and the concept of bases comes in.
Bases.
Basically, it's when the stock price moves sideways for a bit before making its next big move. Picture a cup forming on the chart, a pause before the potential breakout.
Got it. A runner catching their breath.
Exactly. We want to buy when the stock breaks out of this base, ideally with high trading volume.
Like they're bursting out of the gate, ready to sprint.
Precisely.
Okay, so we've got our eye on those breakouts. But the market itself has its own rhythms, right?
It absolutely does. Even the best companies can struggle against a market downturn.
Like swimming against the tide.
Exactly. So you have to understand which way the tide is flowing.
Where do things stand right now?
The market's been off its recent highs, but it's showing some fight.
Encouraging signs.
Both the S&P 500 and the Nasdaq Composite have rallied past some key benchmarks. It's a good sign.
Okay, so there's potential for a rebound. Good news for investors. Which leads us to the 5 companies we're looking at today. Let's start with Shopify.
Shopify's currently in a buy zone. It broke out of a double bottom base, which looks like a double dip on the chart.
Interesting. What does that tell us?
It signals that buyers are stepping in. Strong potential for upward movement.
So positive momentum right out of the gate.
Yeah.
What else makes Shopify stand out?
Their overall performance has been exceptional. Earnings growth is way beyond that 25% target we talked about earlier.
How much are we talking?
Think along the lines of 718% growth over the past 3 quarters.
Wow, that's impressive. What's driving that kind of growth?
A big part of it is their push into the enterprise market. They're not just targeting small businesses anymore, they're going after the big leagues.
Smart move. Expand your horizons. But any potential downsides investors should be aware of.
Their Q4 performance will be key. The holiday season makes up a significant portion of their revenue.
Makes sense. A lot riding on those holiday sales.
Yeah.
Okay, let's switch gears to ServiceNow. They're also making waves in the software world.
They are. And like Shopify, they're also currently in a buy zone. Just broke out of a flat base.
Okay, so another company showing signs of a potential breakout. How about their overall performance?
Stellar track record. Consistently strong earnings. But worth noting, their recent growth has slowed a bit.
How much of the slowdown?
Earnings were up 27% year over year in the last quarter. Still good, but it's the second quarter in a row where that growth has slowed.
Something to watch, but not a deal breaker. What's fueling their success so far?
They're a powerhouse in the back office software market, but they've been strategically moving into the front office as well.
Expanding their reach. Smart. What does front office even mean in this context?
Think customer service management, field service management, those kinds of areas.
So diversifying their offerings.
Exactly. And they've been embracing AI in a big way, integrating it into their products.
AI seems to be everywhere these days.
It's a game changer for sure. Now, on to our third company, DoorDash. They've become a household name in the food delivery space.
They really have. What's their secret sauce?
Like the others, they're also actionable, sitting above a flat base buy point right now, setting up for a potential breakout.
Okay, so another one with upward potential. How do they compare performance-wise to Shopify Shopify, and ServiceNow.
DoorDash has a very good track record, especially when it comes to growth. 2024 was a banner year for them. Their stock soared almost 70%.
That's a huge jump.
And they're already up over 10% this year, even after a slight dip in December.
So the momentum is still there. What's driving those gains?
A big factor is the strong institutional support they have. The big players are buying in.
Always good sign when the smart money is confident. What are they seeing in DoorDash?
Their strategic expansion beyond just restaurants and beyond just the U.S. is a big part of it, diversifying their offerings and reaching new markets.
So thinking bigger, not just about burgers and fries anymore.
Exactly. But here's the thing to watch. Their earnings performance has been a bit inconsistent.
So that's the potential catch.
Their Q4 results will be very telling. Investors will want to see continued profitability and a strengthening bottom line.
Earnings are going to be the key indicator. All right, let's switch gears to the financial sector now. We've got Goldman Sachs on the list. How are they looking?
Goldman Sachs is currently in a buy zone as well, cleared a flat base recently, another potential breakout on the horizon.
Seems like we're seeing that pattern quite a bit today. What's making investors bullish on Goldman Sachs?
They just posted better than expected earnings, which definitely gave everyone a confidence boost. Their earnings per share saw a significant jump compared to last year, and revenue surged as well.
Sounds promising. Which parts of their business are doing particularly well?
Several areas, actually. Their global banking and markets division is strong, along with investment banking and equities trading.
So, firing on all cylinders. What do the analysts think about their future?
Wall Street's expecting continued growth. Full-year earnings projections are healthy, and those estimates have actually been revised upwards recently, which shows growing confidence.
Always a good sign. But are there any risks investors should keep in mind?
The banking sector is cyclical by nature. It's sensitive to interest rate changes and overall economic conditions.
Factors that are outside their control, even if they're managing everything else perfectly.
Exactly.
Okay, makes sense. For our final stock, let's take a look at Royal Caribbean. What's the outlook for them?
Royal Caribbean is also in a buy zone, cleared both a flat base and an early buy point, showing positive momentum, breaking through those key levels on the charts.
Another potential breakout is the theme of the day. How's their overall performance been?
They've had a phenomenal comeback since the pandemic. Earnings are surging as the cruise industry rebounds.
Riding the wave of recovery. What about their future earnings growth? What are analysts predicting?
They're projecting continued growth over the next couple of years, although at a slightly slower pace.
So continued growth, but maybe a bit more moderate. Anything else makes Royal Caribbean an attractive investment?
They've been one of the top performers in the entire market over the past year, comfortably outperforming the S&P 500.
That's definitely a sign of strength. What about institutional support? Are the big players interested?
They are. Institutions have been net buyers of the stock recently. You can see that reflected in their strong accumulation distribution rating.
So they're not just recovering, they're thriving. What's contributing to their success?
Their position as a leader in the leisure services industry group is a big factor. That whole group ranks very highly among all industries tracked by IBD.
So top of their game in a high-performing industry. What else is working in their favor?
They're launching new products, like the recently announced Celebrity River Cruises. Not just riding the recovery wave, they're actively looking for new growth opportunities.
Always a good sign when a company's proactive. What about potential risks or challenges investors should be aware of?
The cruise industry is always going to be sensitive to economic downturns and global events. Plus, rising fuel costs and environmental concerns are factors to consider.
Valid points. Every industry has its own set of risks. Before we move on, don't forget to subscribe to the channel and hit that like button.
We appreciate it.
We'll be back with part 2, where we'll delve even deeper into the financials of these 5 companies. One thing I've noticed as we've been talking is that earnings growth seems to be a really crucial indicator of a company's potential.
Absolutely. Earnings growth is fundamental. It reflects a company's financial health and its ability to create value for shareholders. And often, it's a leading indicator of future stock price appreciation.
And all 5 of these companies, even though they're in different sectors, they've all shown impressive earnings growth in one way or another.
That's a positive sign, for sure. But remember, past performance doesn't guarantee future results. The market is always going to have its surprises.
True. Investing requires careful research, a long-term perspective, and a healthy dose of caution. We'll continue exploring these ideas in Sensent, part 2 of our deep dive into these 5 promising companies.
Welcome back. We've set the stage, talked breakouts, and looked at the overall market. Now let's roll up our sleeves and get into the nitty-gritty of these 5 companies' financials.
Let's start with Shopify. We touched on their earnings growth earlier, but what's the story beneath the hood?
Their latest earnings report had some really interesting details. Their EPS jumped a whopping 167% in the most recent quarter.
167%. Wow. Anything else stand out?
It actually represents an acceleration from the previous quarter.
That's the kind of acceleration that gets my attention. What's fueling this earnings surge?
A few things, actually. Their expansion expansion into the enterprise market is definitely playing a role. Plus, they continue to dominate in the small and medium-sized business space. And of course, they're riding that e-commerce wave, which has only gotten stronger lately.
So, hitting on multiple fronts, can they keep up this pace? What's the long-term outlook?
That's the question, isn't it? Their ability to keep innovating, expanding their offerings, and attracting new merchants will be key.
Because the competition is fierce, right? Especially with giants like Amazon.
Exactly. It's a classic David and Goliath situation.
But Shopify's got that agility, they're constantly innovating, and their merchants are incredibly loyal.
That sense of community is a big asset. It builds trust and loyalty, really valuable in today's market.
Absolutely. Okay, let's move on to ServiceNow. They're playing in a whole different ballgame enterprise software.
Right, and it's a constantly evolving space.
We talked about their track record, but what do the numbers say about their recent financial performance?
Their recent earnings growth has been excellent, although it has slowed slightly the past 2 quarters. Still, earnings were up 27% year over year in the most recent quarter.
So a bit of a slowdown, but still solid growth. Where's that growth coming from?
Their core business is providing cloud-based solutions for enterprises to automate and manage their IT operations. But they've also been expanding into new areas strategically.
Like what?
Things like customer service management, human resources management, diversifying their offerings and reaching new customers.
A smart growth strategy. And they're embracing AI too.
Big time. Integrating AI into their products, which could really supercharge their growth down the line.
AI is the hot topic these days. But what about those slowing earnings? Is that a concern for investors?
It's definitely something to keep an eye on. Analysts are expecting a 17% earnings gain in their upcoming Q4 report. That'll be a key indicator of whether they can pick up the pace again.
An earnings report to watch for sure. Now let's talk DoorDash, the food delivery company that seemingly came out of nowhere.
They've had an incredible run.
But how are their financials looking?
Their revenue growth has been phenomenal, driven by that huge surge in demand for food delivery during the pandemic. But profitability has been a bit more of a journey.
That's typical for companies in the gig economy, right? Managing labor costs and achieving consistent profitability is tough.
For sure. But DoorDash has actually made great strides there. They had their first profitable quarter as a public company in Q3 of 2024.
That's a big win. What are the analysts saying about their future earnings?
The projections are pretty optimistic. They're expecting a dramatic swing from a loss in 2023 to full-year EPS of 30 cents in fiscal 2024. And they're forecasting earnings growth of over 500% this year.
500%. Are those numbers even realistic?
It depends on a few things. Can they maintain their market share? Can they manage costs effectively? And can they continue expanding into new markets? Don't forget, they've got competition like Uber Eats and Grubhub breathing down their necks.
It's a tough market to stay on top of. Innovation and smart strategy are essential. All right, let's turn to the financial sector and talk Goldman Sachs, a true Wall Street powerhouse.
They are indeed.
We mentioned their earnings surge earlier, but I'm curious about the specifics.
Their earnings have been driven by strong performance in their global banking and markets division, as well as investment banking and equities trading.
So, benefiting from the current market conditions, what else is contributing to their success?
Their expense management has been very effective, which has really helped their bottom line. Plus, they've been very strategic in navigating the changing financial landscape.
Always good to be adaptable. But are there any potential challenges ahead for Goldman Sachs?
You always have to remember that the banking sector is cyclical. Things like interest rates, economic growth, and global events, those can all impact performance no matter how well a company is run.
True. Even giants like Goldman Sachs aren't immune to the ups and downs of the global economy. Lastly, let's look at Royal Caribbean, the cruise line that's been riding the recovery wave.
They've made a remarkable turnaround.
We talked about their earnings turnaround, but what do the numbers look like?
Their earnings have been surging thanks to the resurgence in demand for cruise travel. They've also been really good at managing their capacity, which has significantly boosted their profitability.
Capacity management is key in that industry. Matching supply and demand is critical. But what about the long-term picture for Royal Caribbean? Can they keep this up?
Their future success will depend on a few things. Will the cruise industry continue to recover? How strong will the global economy stay? And can they continue to manage costs effectively?
So, a mix of opportunities and challenges on the horizon. It seems like that's a recurring theme today. Companies facing complex situations, adapting to change, and working towards sustainable growth. We've covered a lot of ground in this deep dive into these 5 companies' financials. We've seen great earnings growth, strategic expansions, and innovative uses of technology. But as As we always say, past performance isn't a guarantee of future results. The market's unpredictable, and investing always comes with risks.
A very important point. These are 5 companies with compelling growth stories, solid financials, and the potential to deliver great returns. But as with any investment, you have to do your own research, understand the risks, and make decisions based on your own individual situation and risk tolerance.
Couldn't have said it better myself. Investing is a journey, not a sprint. It's about being informed, being adaptable, and taking a long-term view. And before we wrap up part 2, don't forget to subscribe to the channel and hit that like button.
We really appreciate it.
We'll be back with part 3, where we'll explore the competitive landscape for each of these companies, identify potential threats and opportunities, and really dig into those factors that could determine their success or failure.
Welcome back to the final part of our deep dive. We've covered financials, growth stories, and now it's time to zoom out and look at the competitive landscape for each of these companies.
Because at the end of the day, a company's success hinges on its ability to not just survive, but thrive in the face of competition. It's like a ship navigating treacherous waters. You can have the best crew and the strongest vessel, but if you don't understand the currents and tides, you're going to run aground.
A perfect analogy.
So let's chart those competitive waters, starting with Shopify. They've built a powerhouse in e-commerce, but it's a crowded space. What sets them apart?
Shopify's really nailed their position as the platform for small and medium-sized businesses looking to go online. Their interface is intuitive, they offer tons of customization, and the app integrations are seamless. It's incredibly appealing to entrepreneurs.
It's like they've built a digital ecosystem where even the smallest businesses can compete on a global scale.
Exactly. And it's not just about the tools. They've cultivated a real sense of community among their users.
That's something you don't see everywhere.
It fosters trust, encourages collaboration, and strengthens their market position.
Makes them more than just a software provider.
Right, but they can't afford to get complacent. Giants like Amazon are constantly vying for that same market share.
It's that David and Goliath story again. But Shopify's shown they're nimble and resilient. They're constantly innovating, and they have incredible brand loyalty among their merchants.
They're not just competing, they're building a movement.
Okay, let's turn to ServiceNow. In the world of enterprise software, which is constantly evolving, how do they stay ahead of the curve?
ServiceNow's laser-focused on workflow automation and digital transformation. They're going after large organizations that want to streamline operations, boost efficiency, and improve the employee experience.
Helping businesses adapt to this increasingly digital world.
Exactly. It's not just about selling software, it's about providing solutions to real business challenges.
So meeting the needs of modern enterprises.
And their platform is cloud-based, so it's scalable, flexible, and secure. They're big on innovation and seamless integration with other enterprise systems.
Essential in a market that demands adaptability.
Absolutely.
Now, for something completely different, food delivery, DoorDash has become a household name, but the competition is intense. How are they staying on top?
DoorDash has really focused on the customer experience. Fast, reliable delivery, wide selection of restaurants. They've built a great reputation. And they've been smart about expanding beyond just restaurants.
So they're branching out.
Definitely. They've partnered with grocery stores, convenience stores, even pet supply stores. They're becoming a one-stop shop for on-demand delivery.
Interesting. Expanding their reach.
It lets them tap into new markets and meet evolving consumer demands.
So it's not just about delivering your dinner anymore. It's about connecting consumers with what they need when they need it.
Right.
Now, on to Goldman Sachs, a true giant in the financial world. But even giants have competition. What are their strengths in this evolving landscape?
Goldman Sachs has a powerful combination of assets. They have an incredible pool of talent, a globally recognized brand, and a culture that embraces innovation.
So a legacy of success combined with a forward-looking approach.
Exactly. They're also investing heavily in technology, leveraging data analytics and AI to enhance their services and improve decision-making.
So not resting on their laurels.
Not at all. They've also been strategically expanding into new areas like consumer banking and wealth management.
Diversifying their revenue streams, reaching new customers.
It's all about staying ahead of the curve, recognizing that the world is changing and adapting accordingly.
Now, for our final contender, let's sail with Royal Caribbean and navigate the competitive waters of the leisure and travel industry. What are they doing to stand out?
Royal Caribbean offers a unique blend of itineraries and destinations, appealing to a wide range of travelers. Plus, they've invested heavily in their fleet, introducing new ships with incredible amenities and unforgettable experiences.
It's about creating more than just a vacation. It's about crafting memories.
Exactly. And they've doubled down on enhancing the customer experience. Personalized service, digital innovations, and a commitment to sustainability.
Appealing to a new generation of travelers.
Definitely. Today's travelers are looking for more than just a getaway getaway. They want adventure, enrichment, a connection with the world.
And Royal Caribbean seems to understand that.
They do.
As we wrap up our journey through these 5 companies, what strikes me is their ability to not just adapt to change, but to proactively shape their own destinies.
They're not just reacting to market forces. They're innovating, differentiating themselves, and building lasting value.
It's that spirit of entrepreneurship, innovation, and resilience.
Exactly.
And as we've said throughout this deep dive, investing isn't just about picking winners. It's about understanding what drives success, the competitive dynamics, the long-term trends, and ultimately the stories these companies are telling.
Those are the factors that make investing so fascinating.
They really are. And before we go, don't forget to subscribe to our channel and give this video a thumbs up if you found it helpful. We're always exploring new horizons in the world of business and investing, uncovering those hidden gems, and sharing insights that can help you navigate this ever-evolving landscape. Thanks for joining us.